January 30th, 2026. Silver loses 39% of its value in a single day. Gold drops 12%. The US dollar surges. Nothing about the American economy changed in those 24 hours. No factory closed. No mine opened. No new technology emerged. No war ended. What happened was a name. Kevin Warsh, former Fed governor, Morgan Stanley executive, inflation hawk. The announcement of his nomination as the next Federal Reserve chair triggered what analysts are calling a regime shift, the violent end of what traders had been calling the debasement trade. Billions of dollars evaporated from precious metals markets, not because economic reality shifted, but because perception did. Here's the uncomfortable question. If a single personnel announcement can erase 39% of an asset's value in hours, are we measuring economics anymore? Or are we just measuring confidence, ego, and theater? This isn't an abstract story about traders losing money on bad bets. This is a story about what economic power actually means in 2026. Throughout 2025, ordinary people watched gold surge 66% and silver climb 135%. Not because they were day trading metals, but because the price of gold tells a story about fear. When gold rallies that hard, it means people don't trust the currency. They don't trust the central bank. They don't trust the system to protect the value of their savings, their wages, their retirement accounts. And they had reasons. Geopolitical chaos in the Middle East and Ukraine, aggressive tariff threats disrupting trade, and most disturbingly, a sitting U.S. president launching what he called a criminal investigation into the Federal Reserve Chair, Jerome Powell. The institution that's supposed to be independent of political pressure was being openly threatened by the executive branch. So people hedged. Pension funds diversified. Central banks in Brazil, Russia, India, China, the BRICS nations, accelerated their purchases of gold, trying to reduce dependence on a dollar that seemed increasingly weaponized. By January 29th, 2026, gold hit $5,608 per ounce, a record high. Silver touched 121. These weren't just numbers on a screen. They were a collective vote of no confidence in the stability of the global reserve currency. And then, in 24 hours, it reversed. This matters because when confidence is this fragile, when a single name can swing markets this violently, ordinary people pay the price. Not the hedge funds with stop losses and risk models. They lose money and move on. But the retirees who bought gold as insurance, the workers whose pension funds were overweight in commodities, the small countries whose reserves just lost billions in purchasing power overnight. The mechanism here reveals something darker. We've built an economic system where messaging matters more than manufacturing, where perception overwhelms production, and where the theater of central banking has become more consequential than the actual interest rates. To understand how we arrived at this moment, you need to picture 2025. Throughout the year, Donald Trump didn't just criticize Jerome Powell, he went to war with him. In public remarks, Trump repeatedly blamed Powell for economic headwinds, called for immediate rate cuts to juice growth, and ultimately announced a Department of Justice investigation into the Fed chair for unspecified criminal activity. This wasn't subtle. This was intimidation, broadcast live. Powell, to his credit, held the line. The Fed maintained its independence, but markets watched, and they drew conclusions. If the next Fed chair would be appointed by Trump, would that person maintain independence? Or would they be subservient, a dovish chair willing to print money, cut rates, and subordinate monetary policy to political demands? The leading candidate for months was Kevin Hassett, Trump's former economic advisor, viewed as more pliable, more willing to accommodate the administration's preference for growth over inflation control. Markets priced this in. The dollar weakened. Metals soared. The logic was simple. If the Fed becomes a political tool, the currency becomes less trustworthy. If the currency becomes less trustworthy, you buy hard assets. Then came January 30th. Trump announced Kevin Warsh. Not Hassett, not a loyalist, not a dove. Warsh, the youngest Fed governor in history when appointed at 35, a former Morgan Stanley executive, and most importantly, a vocal critic of the Fed's quantitative easing policies after 2008, an inflation hawk with a reputation for fiscal discipline. The announcement landed like a thunderclap. Within hours, silver crashed from $121 to $85.11. Gold fell from $5,608 to $4,864. The US dollar index surged to 96.94, its strongest single-day performance in years. The two-year Treasury yield gapped up 20 basis points as traders repriced the future of monetary policy. Nothing about inflation changed. December 2025 CPI was still stuck at 3.1%. Core producer prices had surged 0.7% month over month in December, reinforcing that inflation remained a problem. The fundamentals were the same on January 29th and January 31st. What changed was the signal. Here's how this system actually works beneath the headlines. Precious metals don't pay dividends. They don't yield interest. They just sit there, inert, valuable only because people agree they're valuable. The entire appeal of gold and silver as assets is insurance, a hedge against the debasement of fiat currency. When investors feared a politicized Fed under Trump, they calculated that interest rates would stay artificially low, that money would be printed to finance spending, and that inflation would erode the dollar's value. In that scenario, gold becomes essential. It's the anti-dollar. But here's the mechanism most people miss. Metals traders aren't just buying bars and storing them in vaults. They're leveraged, heavily. A retail investor might put down 10% margin to control a futures contract worth 10 times their capital. Institutional traders use even more sophisticated leverage through options, derivatives, and structured products. This works beautifully when the price goes up. A 10% gain on the underlying asset becomes a 100% gain on your invested capital. But when the price gaps down, when silver drops 39% in a day, that leverage becomes a death spiral. Imagine you bought silver at $115 with 10% margin. You put down $11.50 to control $115 worth of silver. When the price hits $85, your position is down $30, but you only had $11.50 in the account. Your broker issues a margin call. Deposit more money immediately, or we liquidate your position. Multiply this across thousands of traders, and you get automated stop losses triggering, forced liquidations cascading, and a flash crash that feeds on itself. This is why the silver drop was so extreme compared to gold. Silver is smaller, less liquid, and more popular with retail speculators. The leverage ratios are higher. The fragility is greater. Kevin Warsh's reputation for fiscal discipline and hawkishness sent a message. The Trump Fed might not be a low rate at all costs institution. If Warsh maintains independence, if he prioritizes controlling inflation over juicing growth, then real interest rates will stay higher for longer. And when real interest rates rise, the opportunity cost of holding gold skyrockets. Why own an inert metal yielding 0% when you can own a treasury bond yielding 4% with lower volatility? The calculus flips instantly. But, and this is critical, nothing about Warsh's actual policy has been implemented. He hasn't been confirmed by the Senate. He hasn't chaired a single Fed meeting. He hasn't set a single interest rate. The market moved on identity, on reputation, on the symbolic weight of choosing a hawk over a dove. This is what I mean by perception overwhelming fundamentals. The crash wasn't triggered by new economic data. It was triggered by semiotics, the meaning of a name. Here's what I think is happening, and why it's more troubling than a simple market correction. Warsh being picked for the Fed, and the resulting metal sell-off isn't coincidence. It's a signal that policy is prioritizing perception over stability. Think about the incentive structure. Trump needs a strong dollar to make his tariff threats credible. If you're going to impose tariffs on Canada, Mexico, China, and Europe, you need those countries to believe the U.S. economy can withstand the retaliation. A weak, debasing dollar undermines that threat. It signals desperation, not strength. So Trump picks Warsh, not because Warsh will necessarily deliver the best economic outcomes for ordinary Americans, but because Warsh's reputation stabilizes the dollar and restores confidence. It's a vibes-based appointment, and it worked. The dollar surged, the debasement trade collapsed, and suddenly the narrative shifted from Trump is weaponizing the Fed to Trump picked a responsible technocrat. But here's the problem. This system is structurally sensitive to ego and messaging, and metals are just the first casualties. If a single personnel announcement can erase billions in value overnight, what happens when the next crisis hits? What happens when Warsh actually does something, raises rates, tightens monetary policy, contradicts Trump's public demands? The volatility won't just affect speculators. It will ripple through mortgage rates, corporate borrowing costs, pension funds, and the prices ordinary people pay for food, housing, and healthcare. Markets react violently because confidence is fragile, not because fundamentals changed overnight. And when leadership choices spark sudden asset swings, it exposes a deeper truth. Economic power today is as much about signaling and influence as it is about supply, demand, or rational calculation. The narrative remains laser-focused on market reaction, as if this is just traders being irrational. But ordinary people feel the consequences. Retirees who bought gold as a hedge against inflation just watched their insurance policy lose 12% of its value in a day. Workers whose pensions were overweight in commodities just took a massive hit. Small countries that diversified into gold to reduce dollar dependence just learned that diversification doesn't protect you when the hegemon can move markets with a press release. The system isn't just volatile, it's fundamentally designed to reward those who can read and manipulate signals, and punish those who believe in fundamentals. To be fair, there are smart analysts who think I'm overstating this. Krishna Guha at Evercore ISI argues the sell-off is an overreaction. His view, Warsh isn't actually a hawk anymore. In recent speeches, Warsh has signaled openness to rate cuts based on AI-driven productivity growth. He's evolved. He's a pragmatist, not an ideologue. From this perspective, Warsh will stabilize perception in the short term, then cut rates once the inflation panic subsides. The metals crash is just traders overcorrecting to a caricature of Warsh's 2008-era views, not his 2026 reality. I take this seriously. Guha is a respected analyst, and it's true that Warsh has moderated some of his rhetoric. The productivity argument is coherent. If AI genuinely boosts output without increasing labor costs, you can have growth without inflation, which justifies lower rates. But here's my response. Even if Warsh does cut rates eventually, the mechanism I'm describing still holds. The market moved on signal, not substance. Traders didn't parse Warsh's recent speeches on AI. They reacted to the brand, inflation hawk from Morgan Stanley, and that brand was enough to trigger billions in liquidations. Whether Warsh actually governs as a hawk or a dove is irrelevant to the deeper point. We've built a system where branding matters more than policy. There's also the healthy correction argument. Commodity bulls like to point out that gold and silver were in a classic blow-off top. The rally throughout 2025 was parabolic, driven by speculation and leverage, not just legitimate hedging. From this view, the Warsh nomination was just the needle that popped an inevitable bubble. The crash would have happened regardless of the catalyst. Again, there's truth here. The metals market was overheated. Silver at $121 was probably unsustainable. But this argument concedes my point. If the market was a bubble waiting to pop, that means it was driven by perception and speculation in the first place, not fundamental supply and demand. Saying it was going to crash anyway doesn't refute the claim that the system is structurally fragile. It confirms it. So who wins, who loses, and who's being distracted? Winners, the Trump administration gains credibility. By picking Warsh, Trump signals that he's willing to accept an independent Fed, at least symbolically. This stabilizes the dollar, which makes his tariff threats more believable. Wall Street wins too. Warsh is a known quantity with deep banking ties. He's not going to surprise them. Losers. Retail investors who bought metals as a hedge. Pension funds overweight in commodities. Workers in mining regions like Nevada, Idaho, and Alaska who depend on high metals prices for employment. Small countries, Venezuela, Iran, Turkey, that rely on gold reserves to stabilize their currencies. They just watch their reserves lose billions in purchasing power because of American domestic politics. Who's distracted? Everyone focused on the market reaction instead of the underlying fragility. The narrative is traders overreacted or speculators got burned, which frames this as a technical event, not a structural problem. But the lesson here is that confidence in the global reserve currency is so brittle that a single personnel choice can swing it wildly. That's not a sign of strength. It's a sign of deep, systemic vulnerability masked by dollar hegemony. There's also a geopolitical dimension. BRICS nations have been trying to build alternatives to the dollar. Bilateral trade agreements, gold-backed settlements, regional payment systems. The metals crash might slow that momentum temporarily, but it also reinforces their original concern. The U.S. can move global markets unilaterally, on a whim, with a press release. That's not a feature of dollar dominance, it's a reason to escape it. This reminds me of August 1971. That's when Richard Nixon unilaterally ended the Bretton Woods system, severing the dollar's link to gold. The decision wasn't driven by economic fundamentals, it was driven by political pressure. France and other allies were demanding gold in exchange for dollars, exposing the limits of American economic power. Nixon's response: change the rules, close the gold window, make the dollar pure fiat, backed by nothing but confidence. Markets adjusted. The world adjusted. And for 50 years, dollar hegemony held, not because of gold, but because of perception. Because everyone agreed the dollar was trustworthy. Because the Fed was independent. Because American institutions were credible. The Warsh nomination is the inverse of the Nixon shock. In 1971, Nixon broke the link between dollars and hard assets to preserve American power. In 2026, Trump is trying to restore confidence in the dollar by appointing a hawk, even if it crashes hard assets. Both are examples of perception management. Both reveal that economic power is ultimately political. The difference is that in 1971, the U.S. could impose unilateral changes because it had unchallenged dominance. In 2026, that dominance is contested. China, Russia, the BRICS, they're watching. And every time the U.S. demonstrates that its currency and its institutions are subject to political manipulation, it gives them ammunition. So let's circle back to January 30th. Silver loses 39% in a day. Gold drops 12%. Nothing about the economy changed, but everything about confidence did. Here's what lingers. If this is how markets react to a personnel choice, what happens when Warsh actually governs? What happens the first time he raises rates and Trump attacks him publicly? What happens when the independence he's supposed to represent gets tested by the president who appointed him? The metals crash wasn't random. It was a preview, a demonstration of how much power perception holds and how little it takes to shatter it. Ordinary people don't trade silver futures. They don't watch the dollar index, but they pay rent, they buy groceries, they save for retirement. And in a system this sensitive to signals, their costs and their security depend on variables they can't see and actors they'll never meet. The Warsh pick calmed the markets. It stabilized the dollar. It ended the debasement trade. But it also revealed the truth. The system isn't built on fundamentals anymore. It's built on confidence. And confidence, it turns out, is just another word for fragility dressed up as strength.